Good morning, welcome to ANZ News. It's Thursday, the 27th of May. Pretty long news today. Sounds like my voice is on its way out as well, so we'll push through, grab a cup of tea, sit back and read through this. Today we're talking the three pillars of inflation. A longer one, but an excellent piece from Crescat Capital on what we might expect to see from here in the US, with both portends similar outcomes here in Australia, but also will directly affect Australia via the effects of the US regardless. We strongly believe investors will want to get positioned now for the great rotation, which is being catalysed by the three macro drivers of inflation, all firing in sync today. First one, demand pull. Two, cost push. And three, monetary debasement. Let us explain why we think inflation is real and what investors should be doing about it. The demand side. In April 2020, household savings peaked at $6.4 trillion. Subsequently, $3.6 trillion of consumer spending was unleashed over the next 12 months. That's equivalent to 7.5 times the historical average annual spending adjusted for inflation. This is relevant because household savings came out recently and the number shot up to $6 trillion again. With the economy reopening, we estimate that consumer spending could surge to as high as $4.5 trillion in the next 12 months. Here's that chart here showing US personal savings for perspective, all the way back to 2006. It's also important to consider the fact that the balance sheet of US households, especially those in the bottom 50% of net worth, also look significantly stronger. The total liability to asset ratio for the lower class is not only in a long-term downward trend, but is now at its best condition in almost 2 decades. Here's that US bottom 50% liability to asset ratio. Interesting. Supply shortages. Additionally, historic amounts of savings are likely to create a wave of consumption that the supply chain is ill-equipped to handle. Here's a chart here showing US inventory to sales. Not in a good condition to handle those sales by the look of things. Back in December, we wrote about the economic ramifications the US suffered during the Spanish flu of 1919 and how that period should serve as a roadmap for the current macro environment. As the economy shut down then, industrial capacity was drastically reduced, and with that a major gridlock in the production of raw materials was created, particularly within the natural resources sector of the economy. In a very similar fashion to today, this bottleneck resulted in severe upward pricing pressure in consumer goods. We now believe a second wave of these developments is underway. In our view, the economy is at the early stages of an upsurge in labour management conflict. As the general supply shortages escalate and consumers start noticing the inflationary burden in their daily expenses, pressure to increase wages is sure to follow. To provide some context, we experienced this problem across all industries of the economy during the Spanish flu. Back then, workers revolted against their employers by demanding materially higher wages and salaries. In fact, 1 out of 5 people in the US labour force was engaged in a strike. We believe a similar trend is brewing in the US today. Large restaurant chains such as McDonald's and Chipotle are already experiencing pressure from employees to increase pay and provide more appropriate work conditions. We think it's a matter of time until further protests emerge in other parts of the economy. However, other important factor today is significant more inflationary than in Spanish flu times, is that government policies are magnifying the labour shortages problem by discouraging folks to return to the labour force. Next one shows some shocking comments from executives as part of the Fed manufacturing report. This from the first comment. Our Human Resources Department reports that even at a starting pay for non-skilled level workers of $14 per hour, we cannot fill our 20 plus open positions. People don't want to go back to work when they can stay at home and collect $400 or more per week in unemployment. Next comment here. Government stimulus money given to individuals has drastically reduced the number of people seeking a job and reduced the incentive to show up and do their job. Labour is becoming a real problem as a direct result of the handouts. And the third comment here, we need to hire people, but it's difficult when people are making $15 per hour to stay at home on unemployment. Today's inflation is not likely transitory. Amid such a macro puzzle, one thing is clear. Inflation is progressively turning into a prevailing narrative among people. The acuity of the natural resource supply and labour shortage problem is not only leading to higher consumer prices, but it's also creating a reflexivity dynamic that feeds a longer lasting inflationary story. The idea here is that inflation is no longer transitory when expectations for rising prices become embedded in consumer and business spending and investment decisions. Such was the wage price spiral that defined the 1970s macro landscape in the US and is likely to be a main feature of the current decade. Like then, it should be a great decade to own the world's premier exploration-focused gold and silver mining stocks. Here's some GDX versus inflation expectations, shown here. Interestingly, the number of companies that mention the word inflation on earnings calls is now growing at a pace we've never experienced before. The same is happening with Google Trends, which we're going to show in this next chart. Long-term inflationary cycles are often initiated by a general concern of the population in holding cash. Here's that search trend here by Google. The Great Rotation. Until now, annual increases in wages and salaries has been on a downtrend for 40 years. Over that same time frame, the corporate cost of capital has declined. The macro landscape encouraged companies to favour growth over profitability. More recently, the post-GFC years of ongoing accommodative monetary policies have enabled the largest number of money-losing businesses in history. As a byproduct, traditional value investing principles have become highly out of favour, while growth and index-style investing have predominated. But now, with inflationary forces in new full swing, we believe a major trend reversal is upon us. Analogous to noticeable macro cycles throughout history, the effectiveness of equity fundamental factors also changes over time. We believe near-term growth, profitability, and valuation factors will become priorities again as part of the security selection process. We also believe forward-thinking analysts will start applying higher discount rates to incorporate rising inflation, if not yet interest rate risk, into the calculation of the present value of longer-term expected cash flows and their DCF models. This development has already started to take place. We've been calling it the Great Rotation. Our premise continues to hold that capital will flow out of expensive long-duration growth equities and fixed income securities and into a narrow group of tangible commodities in scarce supply and in high demand, as well as low valuation natural resource stocks that offer high cyclical near-term growth prospects, strong profit visibility, and inflation hedging properties. At historically high broad market valuations for equities, we see downside risk for unprofitable companies with high debt and low pricing power in the current macro environment. We also see macro risk with respect to what we believe is an insane bubble in abundance of cryptocurrencies, a new class of highly speculative intangible assets that are not even securities, rather an unregulated, highly speculative new technological asset class of software tokens whose market today resembles a hybrid of the 2000 dot-com bubble and the 1636 Dutch tulip bulb mania. Surely there will be long-term winners in crypto. We hope to be able to discern them up as they rise from the ashes after the coming spectacular bust. After all, Facebook and Google only emerged after the tech bust, while Amazon was crushed during it, going down 97% within 2 years before rising from the ashes to become the third largest market cap in the US today. The chart we're going to show next shows the enterprise value to sales ratio differential between high-flying technology and value stocks. Note the comparison between the early stages of 2001 and 2, tech bust, and today. Is that there? Monetary debasement. The third major driver of inflation is monetary debasement. The current framework of analysing the state of the labour market and the true levels of inflation in the economy to rationalise the appropriate monetary policy have never been so unfitting. By solely observing the recent macro data, Jerome Powell and other Fed members have all the right reasons to signal tapering in their last meeting and decided not to. Contrary to what most believe, today's quantitative easing program and near zero interest rates completely disregard both sides of the central bank's dual mandate, which is supposed to control inflation and maintain full employment. Instead, in our view, monetary policy has only one clear objective: to prevent interest rates from rising so our government can fund massive fiscal spending. So now we genuinely ask, how can the Fed reverse its ultra-easy monetary policies with an economy running on a twin deficit of 25% of the nominal GDP? Here's that chart here showing twin deficits. Too much debt. Or, on another thought, how does the Fed unwind the alligator mouth we're going to show next? Corporate debt has grown to near all-time highs, while bond yields remain at all-time lows. Again, this is all a product of easy money policies. Here's that chart here showing US corporate debt versus bond yields. Ultimately, the Treasury market holds the key for the health of the financial system. With current high debt to GDP levels, the economy has an inherent need for loose financial conditions. Correspondingly, the sheer magnitude of the excess liquidity in the markets has created one of the most speculative investment environments of all time. As such, any marginal increase in interest rates would be detrimental for financial assets at near record valuations. And we've talked about that before, with current debt to GDP at 130%. CPI not credible. Truth be told, a highly indebted and broken government is at the mercy of the Fed. Policymakers have no other options other than to continue pumping liquidity into the system while making absurd claims to justify their actions. Most consumer goods and commodities have started to go vertical in prices within the last 1 to 2 years. And bizarrely, the Fed's own calculation of inflation just reached a 7-year low. This is what they call a data-driven approach. Here's that medium CPI year on year, which doesn't really make too much sense considering the liquidity that's been thrown at the market. Real yields are what matter. As stimulative packages become exponentially larger in size, the curve of efficacy for monetary policy is peaking. We believe the Fed stimulus is transitioning from a diminishing return phase to a negative one. The scarcity of financial assets yielding anything in real terms is creating a vigorous capital flow dynamic that is incredibly attractive for undervalued tangible assets. With growing concern of monetary debasement emerging, investors continue to bid up commodity prices, leading to higher consumer prices. This should start becoming an issue for equity markets as excessive valuations yielding less than inflation. For instance, the S&P 500 earnings yield adjusted for CPI is now at its most negative level in 30 years. It is likely much worse because this is using what we strongly believe is an understated measure of true inflation. Monetary dilution can only lead to higher financial asset prices until inflation begins to develop. At that point, as capital costs rise, Fed's policies become counterproductive and a price reset for historically overvalued assets is needed. Here's that S&P 500 real earnings yield. We're already below the tech bubble and housing bubble. Tomorrow, in the context of all the above, we'll share why they think silver is the single most important asset that we, as a firm, are focused on. Wow, that's the big news from today. Thanks, Crescat, for that information. Jump over to anzbullion.com.au for all things physical, anzwealth.com.au for all things cryptocurrencies, and goldsilverstandard.com for our own crypto built and backed by Ainsley. Catch you tomorrow and enjoy your day.